In 1965, the average CEO of a major American corporation made 20 times more than their average worker. 20 to 1. The CEO made $500,000, the worker made $25,000. That gap seemed large at the time. People debated whether it was fair, but at least it was comprehensible. You could understand why the person running a massive corporation made 20 times more than someone on the factory floor. Fast forward to today. The average CEO of an S&P 500 company makes 350 times more than their median worker. 350 to 1. Some CEOs make over 1,000 times more. The CEO of Walmart makes 1,076 times what the median Walmart worker makes. The CEO of Amazon made 6,474 times the median Amazon worker in recent years. These numbers are incomprehensible. They're obscene. And here's the question that should keep you up at night. Did CEOs suddenly become 17 times better at their jobs than they were in 1965? Are they 17 times more valuable? 17 times more productive? Of course not. The job hasn't changed that much. So what happened? Why did CEO pay explode while worker pay stagnated? And here's the part that should make you angry. This isn't about market forces. This isn't about supply and demand. This isn't about CEOs earning what they're worth. This is about power. This is about a system that was deliberately restructured over 50 years to transfer wealth from workers to executives. And in the next 10 minutes I'm going to show you exactly how it happened, who made it happen, and why this is one of the clearest signs of a late-stage empire extracting wealth from the many to enrich the few. Because CEO pay isn't an accident, it's a design. And understanding that design is understanding how the empire economy really works. Let's start with the mechanism. How do CEOs actually get paid so much? It's not just salary. Most CEO compensation comes from stock options and stock awards. Here's how it works. A CEO gets a base salary, maybe $2 or $3 million. That's the small part. Then they get stock options. These are contracts that let them buy company stock at a set price in the future. If the stock price goes up, they exercise the options and make millions or tens of millions. They also get restricted stock awards, free shares of stock that vest over time. When the stock price rises, these shares become incredibly valuable. The total package, salary plus options plus stock awards, can be 50 million, 100 million, even hundreds of millions of dollars. Now the justification for this is that it aligns CEO incentives with shareholder interests. If the CEO makes the stock price go up, shareholders benefit and the CEO benefits. Everyone wins. That's the theory. But here's the reality. CEOs have learned to manipulate stock prices in ways that actually create value for the company or benefit workers or improve products. They've learned to game the system. The easiest way to boost stock prices in the short term is stock buybacks. The company uses cash to buy its own shares. This reduces the number of shares outstanding, which makes earnings per share go up, which makes the stock price go up. The CEO's options and stock awards become more valuable. The CEO gets rich, but the company didn't actually grow. They didn't invest in research, didn't raise worker wages, didn't build new factories. They just used financial engineering to inflate the stock price. This is extraction, not creation. And it's become the dominant strategy. In 2023, S&P 500 companies spent over $1 trillion on stock buybacks. $1 trillion that could have gone to workers, to innovation, to long-term growth. Instead, it went to inflating stock prices so executives could cash out their options. Let's talk about how this system emerged because it didn't always work this way. In the 1950s and 60s, CEO pay was mostly salary and cash bonuses. It was high but not obscene. The ratio of CEO to worker pay was relatively stable around 20 to 1. Then in the 1980s and 90s, everything changed. Several forces converged. First, the rise of shareholder primacy ideology. An economist named Milton Friedman argued in a famous 1970 essay that the only responsibility of a corporation is to maximize shareholder value, not to serve workers, not to benefit communities, not to consider the broader social good, just maximize profits for shareholders. This idea took over corporate America. Business schools taught it. Investors demanded it. Boards of directors adopted it. Companies that didn't maximize shareholder value were seen as failures. CEOs who cared about workers were seen as weak. Second, changes in tax law made stock-based compensation more attractive. In 1993, Congress capped the tax deduction for CEO salaries at $1 million. The intent was to limit CEO pay, but there was a loophole. Performance-based pay, like stock options, was exempt from the cap. So companies shifted compensation from salary to stock options. CEO pay exploded. The law designed to limit pay actually enabled its explosion. This is what happens when you don't understand how executives will respond to incentives. Third, the rise of institutional investors and activist shareholders who demanded higher returns. Pension funds, mutual funds, hedge funds, they controlled massive amounts of stock. They pressured companies to maximize short-term stock prices. If a company didn't deliver, they'd sell the stock or push for management changes. This created enormous pressure on CEOs to boost stock prices by any means necessary, and the easiest means was cutting costs, which meant cutting worker pay and benefits. Fourth, the decline of unions. In the 1950s, over 30% of American workers were union members. Unions negotiated for higher wages and better benefits. They had power. By 2024, union membership is around 10%. Workers lost bargaining power. Without unions, workers couldn't demand a share of productivity gains. All the gains went to shareholders and executives instead. These four forces, shareholder primacy, ideology, tax law changes, institutional investor pressure, and union decline, they combined to create a system where CEO pay became untethered from any rational measure of value. CEOs were paid in stock. Stock prices became the only metric that mattered. And CEOs learned to manipulate stock prices through financial engineering rather than actual value creation. The result is the 350-to-1 ratio we have today. Now let's talk about why this is economically destructive, not just unfair. When CEOs are incentivized to maximize short-term stock prices, they make decisions that harm the long-term health of companies and the economy. They cut research and development because R&D is expensive and doesn't boost stock prices immediately. They lay off workers to reduce costs and boost earnings per share. They offshore production to low-wage countries to increase profit margins. They avoid investing in training and equipment because those are long-term investments that do pay off this quarter. They load companies with debt to fund stock buybacks, making companies financially fragile. All of these decisions boost stock prices in the short term. The CEO cashes out their options. Then they leave for another company or retire. The long-term consequences: a weaker company, a less innovative economy, destroyed communities. These are someone else's problem. This is systematic short-termism, and it's directly caused by how CEO pay is structured. Let's look at the contrast with the 1950s and 60s. CEOs then were paid mostly in salary. They didn't have massive stock option packages, so they thought long-term. They invested in their companies. They built things. They trained workers. They developed new products. They created value, and yes, they made good money, but they didn't extract hundreds of millions while workers struggled. There was a sense that everyone in the company was on the same team. When the company did well, everyone benefited. Profits were shared more broadly. This wasn't socialism, this was stakeholder capitalism. The recognition that a company has obligations to workers, communities, and customers, not just shareholders. It worked. American companies dominated global markets. The middle class thrived. The economy grew. Then we switched to shareholder primacy and everything changed. Now companies are optimized for short-term stock prices. CEOs are paid obscene amounts to deliver those prices. Workers are treated as costs to be minimized. Communities are abandoned when it's profitable. The economy is more fragile. Inequality has exploded, and we're told this is efficient. This is what the market demands, but it's not the market. It's a system that was constructed, a system that could be changed. Now let us connect this to the empire pattern because extreme inequality and wealth concentration are hallmarks of declining empires. In rising empires, wealth is relatively broadly distributed. There's a strong middle class. Social mobility exists. Elites are wealthy, but not obscenely so. Everyone feels they have a stake in the system, but in declining empires, wealth concentrates at the top. A small elite captures most of the gains. The middle class shrinks. Social mobility freezes. Resentment builds. Eventually, the system becomes unstable. Rome followed this pattern. In the early republic, wealth was relatively distributed. Small farmers owned land. Soldiers came from the middle class. But over time, wealth concentrated in the hands of a few senatorial families. Land ownership consolidated. The middle class disappeared. By the late empire, you had a tiny ultra-wealthy elite and a vast poor population. Nothing in between. The elite lived in luxury while the masses survived on state handouts. Sound familiar? The CEO to worker PE ratio is one of the clearest measures of wealth concentration, and by this measure, we're in late-stage empire territory. A 350-to-1 ratio is not sustainable. It's not healthy. It's a sign of a system that's broken. A system where those at the top can extract extraordinary amounts while those below see their share shrink. Let's talk about the justifications for extreme CEO pay because defenders have several arguments. First, they say CEOs are paid what the market determines they're worth. If companies are willing to pay that much, it must be because CEOs deliver that much value. But this ignores how CEO pay is actually set. It's not a free market. It's determined by boards of directors. And boards are often filled with other CEOs and executives who have every incentive to keep CEO pay high. They sit on each other's boards. They hire the same compensation consultants. They benchmark CEO pay against peer companies, creating a ratchet effect where every company wants to pay above average, which drives the average up, which drives everyone's pay up. This is not a market. This is a cartel. Second, they say CEO jobs are incredibly difficult and stressful. Only a tiny number of people can do the job, so you have to pay a premium. But this argument falls apart under scrutiny. CEO jobs are difficult, but are they 350 times more difficult than in 1965? Are today's CEOs superhuman compared to the CEOs of the past? Obviously not. The job has not gotten 350 times harder. The pay has gone up because the system allows it, not because the job demands it. Third, they say if you don't pay competitively, you'll lose talent to other companies. But studies show CEO performance is weakly correlated with pay. Some of the best performing CEOs are modestly paid. Some of the worst performing CEOs are wildly overpaid. There's no strong evidence that paying more gets you better performance. In fact, there is some evidence that excessive pay leads to worse decisions because CEOs focus on short-term stock manipulation rather than long-term value creation. Fourth, they say CEOs take big risks and should be rewarded, but the downside for CEOs is minimal. If they succeed, they make hundreds of millions. If they fail, they get a golden parachute severance package worth tens of millions. Workers take risks too. If the company fails, they lose their jobs, their healthcare, their pensions. They have no golden parachute. So the risk argument doesn't hold. CEOs are insulated from the downside while workers bear all the real risk. None of the standard justifications for extreme CEO pay withstand scrutiny. The real reason CEO pay is so high is power. The people who set CEO pay are themselves highly paid executives. They're part of the same class. They have every incentive to keep pay high. And workers have no voice in the process. Shareholders occasionally vote on executive compensation, but those votes are mostly symbolic. The system is rigged by and for executives. This is not a market outcome. This is a power outcome. Now let's talk about the consequences for workers, because when the pie is divided so unequally, workers get less. If a company generates $1 billion in profit, and the CEO takes 100 million, that's 100 million not going to workers. You might say 100 million divided among thousands of workers isn't much per person, but scale that across the entire economy. Trillions of dollars over decades flowing to executives instead of workers. That's real money. Money that could have been wages, benefits, pensions, training. Instead, it went to stock buybacks to enrich executives and shareholders. The workers' share of national income has been declining for 50 years. In 1970, labor's share of GDP was about 64%. Today, it's about 58%. That 6-point difference represents trillions of dollars transferred from labor to capital, from workers to owners and executives. This is extraction. This is the empire economy. Take from the many, give to the few. And CEO pay is the most visible manifestation of this. Let's look at this from a moral perspective because the numbers are so large they become abstract. So let's make it concrete. The CEO of Walmart makes about $25 million per year. The median Walmart worker makes about $25,000. The CEO makes in one day what the worker makes in 1 year. In 1 hour, the CEO makes what the worker makes in 1 month. Is the CEO working that much harder, contributing that much more value? Or is this a system where power determines rewards and the powerful have rigged the system in their favor? Consider what this means for the worker. They're working full-time, 40 hours a week, often on their feet, dealing with customers, stocking shelves, running registers, hard, necessary work. Without them, Walmart doesn't function, and they make $25,000. That's barely above the poverty line. They probably qualify for food stamps and Medicaid. so taxpayers are subsidizing Walmart's low wages. Meanwhile, the CEO who makes decisions in boardrooms, who attends meetings, who certainly works hard but doesn't work 1,000 times harder, makes 25 million, enough to buy multiple mansions, private jets, generational wealth. This is not a meritocracy. This is an aristocracy, a system where the people at the top use their power to capture obscene amounts while the people at the bottom struggle to survive. And the rhetoric is always about efficiency and markets. But it's really about power, about who gets to set the rules and who benefits from them. Now let us talk about solutions, because this system was created by policy choices and it can be changed by different policy choices. First, change tax laws. Tax stock-based compensation the same as salary. Close the loopholes that incentivize excessive option grants. Implement higher marginal tax rates on extreme incomes. In the 1950s, when CEO pay was reasonable, the top marginal tax rate was 90%. Today it's 37%. Raising it wouldn't eliminate high pay, but it would reduce the incentive to grab every possible dollar. Second, reform corporate governance. Give workers representation on corporate boards. Many European countries require this. When workers have a voice in corporate decisions, including executive pay, outcomes are more balanced. Ban stock buybacks or heavily restrict them. Stock buybacks were illegal until 1982. They're a form of market manipulation. We should treat them as such. Third, strengthen unions and worker bargaining power. When workers can collectively negotiate, they get a fairer share. Union workers earn about 10 to 15% more than non-union workers. Unions also reduce inequality by compressing the pay distribution, make it easier to form unions. Ban anti-union tactics, empower workers. Fourth, require transparency. Make companies disclose not just CEO pay, but the ratio of CEO pay to median worker pay. Sunlight is a disinfectant. When people see the ratios, they're outraged. That creates pressure for change. Fifth, implement maximum wage ratios. Some have proposed laws limiting CEO pay to a certain multiple of the lowest paid worker, say 50 to 1. If you want to pay your CEO more, you have to raise your lowest wages. This directly ties executive compensation to worker welfare. Will any of this happen? Probably not in the near term. The people who benefit from the current system have enormous political power. They fund campaigns, they lobby, they control the narrative. Change is difficult, but understanding the system is the first step. Understanding that extreme CEO pay is not natural, not efficient, not justified. It's a policy choice, a system constructed to benefit executives at the expense of workers, and what's constructed can be deconstructed. History shows that extreme inequality eventually triggers backlash, either through reform or through revolution. We're moving toward one of those outcomes. The question is which? The 350 to 1 ratio is not sustainable. It creates resentment, it undermines social cohesion. It makes the economy fragile. Eventually, something breaks. Either we reform the system before it breaks, or it breaks and we deal with the chaos. Those are the options. Maintaining the status quo is not viable long term. This is why CEOs make 350 times more than their workers, not because they're 350 times more valuable, not because the market demands it, but because a system was constructed over 50 years to concentrate wealth at the top. Stock-based compensation that incentivizes short-term thinking and financial manipulation. Boards filled with executives who set each other's pay. Weak unions that can't bargain for workers. Tax laws that favor capital over labor. Shareholder primacy ideology that treats workers as costs to minimize. All of these pieces fit together to create a machine that transfers wealth from the many to the few. And CEO pay is the most visible output of that machine. It's a symptom of a deeper problem. The problem of an economy designed to extract rather than create, to concentrate rather than distribute, to enrich the elite while everyone else struggles. This is the empire economy. This is what late-stage empires look like. Extreme inequality, wealth concentration, a tiny elite living in obscene luxury while the masses fall behind. It's not sustainable, it's not healthy, and it's not an accident, it's a design. And the people who designed it are the same people who benefit from it. This is the empire economy, where we decode the systems that concentrate wealth and power. CEO pay is one of the clearest examples. A 350 to 1 ratio is not an economic necessity, it's a political choice. And understanding that is the first step to changing it. Because the alternative is watching inequality grow until the system collapses under its own weight. And collapses are ugly. Reform is better, but reform requires understanding how we got here. Now you know. The question is what you do with that knowledge.